So, what could be a balanced allocation amongst asset classes and within equity itself for a medium risk appetite investor?
It's just a normal correction in structural bull market. Most of the damage seems to be behind us, 80-90%. The first time when domestic investors are benefiting from India wealth creation story. So I think by and large that is behind. We will see meaningful inflow happening only once the Fed rate starts cutting happening and fresh flow comes towards emerging market. So I guess banks should do well this year. Nifty in 2002 was 800 points. Today we are after correction at 22,000 points.
What do you make about investing in gold ETFs?
I think gold, I had never been a big believer of gold as an asset class.
Hello, everyone. We have another market veteran with us today. He not only loves markets but also shares a deep sense of interest for psychology, spirituality, and fitness. He is Mr. Vikas Khemani, the founder of Carnelian Asset Management and Advisors. He oversees assets worth more than 10,000 crore. And let's begin decoding the market through his lens. Hello, sir.
Hello, hi.
So to begin with, I wanted to understand what's the sense that you're getting from client interactions as well as market reading. What do you make of the whole market situation right now, and whether are we really entering a bear territory right now?
So I think we've seen market correcting about 18-20%. And these kind of corrections are par for course in normal market cycle. It happens every 2-3 years, if you see. It kind of reminds me of something what happened in 22. We had a great 21 and great second half of 2020. So market was on a good backdrop of a bull market, and the Ukraine war started. And if you remember, market Nifty corrected then from 18,500 to 15,500, so almost 18-20% correction. And in that correction, many stocks corrected 40-60%, small and mid cap stocks. And that time also a lot of concerns around geopolitical, inflation, oil price, all those were there. And as they settled down, second half of 2022 and 23 and first half of 24 ended up becoming very good. So I think it's a kind of pretty much similar kind of sentiment I see right now, where people are right now fearful, started questioning long-term India story, which happens every time market does like that. So I think in my opinion, it's just a normal correction in structural bull market. Most of the damage seems to be behind us, 80-90%. But long-term story is still intact. That's where at least how I see, and it might take time to come back. It might take 3-4 months, like how it took again in 22. And it will always come back on the legs of skepticism. Market always recovers back on the legs of skepticism. So it will happen this time around as well. I don't see any structural weakness in Indian markets.
Why do you say that we will take a few months to recover? Like, are you seeing some challenges? What are the hurdles that you're probably seeing?
No, I think market momentum is broken. Investors earlier who were in a mood to buy on dips have become sell on rallies, right? Because the fear has kind of got in. So again, if you see market swings between greed and fear, 6 months ago, people were waiting for correction to buy. Same people now, are waiting for selling on rises. So it's a very natural, and unless some major trigger happens which creates a runaway rally, which I don't see on the horizon, right? Anything can happen. Market triggers can come both sides without even realizing. But I think that it will probably earnings will start picking up in the second half of this year. That is where you will see market recovering.
Perhaps it's too early to ask you about redemptions, but before recovery, do you see any kind of redemption pressure? Do you see mutual funds facing redemption pressure?
It could happen because, like I said, markets are right now getting captured by the fear, and some amount of fearful investors would redeem. But I don't think it will be like an alarming kind of number which can sort of derail Indian story. Because for every redemption, there are more and more investors who are also believing that this temporary corrections are good time to buy, which it is. So like if I were to look at our data, we are net positive inflow. So it means we are getting more money than we are letting go. So I am reasonably sure that this is true for most of the AMCs throughout. So yeah.
When we look at India, or even emerging markets for that matter, what would be the consequence of higher tariffs being imposed by the US government?
So I think first of all, we'll have to see how it folds out. We don't know right now. There's a lot of rhetoric going on. We don't have anything actual, right? The fact of the matter that US cannot produce in US because they don't have manpower resources. So I think there are political rhetorics and realities. Of course, the China situation is tricky. So what they do in terms of tariffs on them, Trump also would not have many choices from a living too much tariff perspective because it could be inflationary. So somewhere I guess some give or take will happen. But I think it should settle down next 3 to 6 months. I do not see any major step, at least as far as India's story is concerned, from a derailing the story perspective. There could be tactical adjustments in one or two industries here and there. They could change, but that I don't think is anything to worry about at a structural level.
Does that probably hamper the prospects of export-facing companies?
Not really. That's what I'm saying. It's not that US is going to ban export or put tariffs on everything else. I don't think that. Like I said, if they put tariffs on China, it's good for India, right? But if they put on China and India, then you are at par. It makes no difference, right? So US cannot put tariff on all countries in the world and still import and consume, because fact is that even if they want, they can't produce, and certainly not overnight. So these are the things which are, if tariffs were so simple, I think in my opinion, they would have been announced in a week's time. Today, it's almost 1.5 months, but we don't have any major concrete tariffs out. It means what? It's not so simple. So I don't think anything derailing should happen, but only we will know when the real detail comes out.
What about the US imposing tariffs on other nations? Will that in any way impact Indian equities?
That's good for us, right? If they impose on China, another nation, not on India, it's good for us because to that extent our goods become more competitive and attractive, and our story can, get momentum.
On the flows front, actually, FIIs have been selling. They've sold almost $14 billion in this year itself. And as compared to near less than actually $1 billion last year. So what do you make of that? I mean, because FIIs, even if they've been selling, there has been a correction, and that has removed froth, that has reduced valuations also to an extent. So what is exactly bothering FIIs at this point of time? What is triggering it?
So if you see in last 3-4 years, I think, FI, if you study it long term, FI flows towards emerging market, including India, is linked to the US Fed rate going up and down. I think post-pandemic, when they started raising the rates, that is when, you saw emerging market outflow happening, including India. Now, India was overweight, hence India got a little bit more outflow, right? And last year, when there was only one time when Fed rate came down, if you look at data in that month, we had a positive inflow so when the Fed rate comes, but then again, US yield tightened, and hence outflow started happening. Also in this period, a lot of adjustments happened within the emerging market basket between India and China. Earlier, India was beneficiary, China started picking up post their monetary policy, that readjustment happened. So I think by and large that is behind. We will see meaningful inflow happening only once the Fed rate starts cutting happening and fresh flow comes towards emerging market. I can tell you there's no negative, perception of India about, that India is not a great story. It will come, it will come with the lag, especially it will link to the Fed rate coming down.
Is it India and China, or is it India versus China in terms of investing now? Like, are investors pulling out of India and putting in China? They want to put both.
No, like I said, it's an emerging market basket. In emerging market basket, each market has a weight. Now, sometimes they go overweight, underweight, different countries, right? It's like when we invest into sectors, we are sometimes overweight on one sector, sometimes underweight on another sector, and we keep changing that. Same way when allocator, emerging market fund managers increases the weights at a country level. So till last year, they were significantly underweight China and overweight India. And then that changed. So now if they decide to become China overweight or equal weight, the money has to go from something what is overweight.
Yeah.
So it has to be only India. Because these are two large bulky markets. So that's how money has gone back from India. But that's not like negative for India. I mean like negative on India. It's more positive on China because that was undervalued. And that's what has played out.
And I mean, on the contrary, if we look at DIIs, they've been quite resilient. But what gives them the confidence to pour money? Like, is it the structural long-term story? But what about the near-term?
So it is not DII. DII actually gets money from the retail. Now, retail continues to invest money into Indian market. That faith is unshaken. And hence DII can sit on some amount of cash, but they can't sit on infinite amount of cash. So they have to deploy. So I think India is going through massive reallocation towards equities through SIPs and others, right? That is not stopping. Today also we are less than 5% of the total household savings into equities. This number can go as high as 15%, 20% over the next 10, 15 years. Now, even if it goes to 10%, India will get additional $2 trillion of flows. Now, that's a large number over the next 5, 7, 10 years, whenever, I don't know, it happens. So this is not, in my opinion, meaningfully stopping anytime soon. So that's good news that domestic investors are owning equity, because historically, domestic investors never created value out of India growth story. The first time when domestic investors are benefiting from India wealth creation story.
And I mean, you spoke about sitting on cash. So there are some portfolio managers who are actually holding on to high cash levels. So how do you read that? What is it hinting at? Is it hinting that there is more nervousness to come and hence more redemptions? Or how are you reading that?
That is the view of those portfolio managers. Of course, you will sit cash only when you are having a view on negative. Otherwise, why would you sit on cash? But I would assume that that's a very small minority. At this stage, even I am assuming those investors are also turning and investing.
So you've been observing the market definitely, and also interacting with investors. So have you noticed any interesting emerging trend in the market? Any trend that you find interesting in terms of investing, maybe sectoral wise or?
See, trends keep coming, depending on, manufacturing is a trend which we've been highlighting for the last 3, 4 years, continues to remain very, very strong, because I think a lot of, things yet to happen. India has just begun, and it's a very long term. I think that will continue to play out. Infrastructure build out is a very interesting trend, which I think is, hugely still yet to play out. This year, I think a lot of banks, because of last year's tightening of RBI, took a knock. I think this year could belong to banks, where, as RBI tightened, ease liquidity, cut interest rate, ease risk weightage, all those things have played out. So I guess banks should do well this year. Those are some of the smaller trends. Other than that, I think long-term structural trends are many, consumption, premiumization, many trends one can talk about, one can go on for hours.
What do you make about investing in gold ETFs?
I think gold, I had never been a big believer of gold as an asset class. But yeah, it has protected value of money over a period of time, especially in the dollar terms. So partly because of dollar, but if you just take the dollar returns out, I mean, if you take the dollar rupee return out, it has really not been a great asset class even over a long term. So essentially, when you buy gold, you also invest into dollar. And that's what the return has come to you. So I'm not been, big believers, I'm an out and out equity guy, which is more productive asset class.
So what could be a balanced allocation amongst asset classes and within equity itself for a medium risk appetite investor?
So I think, there are, balanced funds there which invest both equity and, debt, fixed income. Those are the good ones for middle risk taking. They give 50-60% equity, balanced debt, tax efficient instruments. Those are the good ones.
What could be a wise strategy for an investor who's feeling trapped in this market?
Who's feeling trapped? I think, if you're feeling trapped, you can feel trapped only when you invested without any strategy. Or you invested based on the hearsay or tips and all. Otherwise, you will not feel trapped. Because, investors, these kind of correction, like I said, are powerful, of course. It happens often. But I would say if you invested and your portfolios are down, as long as you are invested into good quality companies, don't worry. They will play it out. We have seen many such corrections in the past. Like I gave you example of 22. There's always light at the end of the tunnel. There's no structurally wrong with the Indian economy and markets. Now, whether it takes 3 months, 6 months, 9 months, nobody knows. But I think markets will come back. Markets will deliver returns.
So we had a conversation few months back, and you told me one thing, that any correction can be lived through remaining invested in it, in the market. So do you still hold on to that view now?
Yeah, absolutely. Nothing has changed because I think even 10% down also will not change anything because we have seen Indian equities creating long-term wealth. Think about it, Nifty in 2002 was 800 points. Today, we are after correction at 22,000 points. Many corrections have come, gone, sustained, right? Markets have sustained. So this is the real India story. And this 22,000 will become 1 lakh. It's a matter of time.
You're quite confident in the market. But also, as a caution for investors, what would you tell investors to be wary of or pay more attention to, even looking out or considering that there is a bull market ahead? But what are the signs that you would tell investors to watch out for?
I think, first of all, I would say don't invest on tips. Don't invest on, don't read too much negative news. Because in bad time, negative news comes all the time. So right now, it sells to only scare and play negative news. So I would say that avoid that and stay invested. That's the only way to sort of come out of it.
So that was a wonderful and elucidative conversation with Mr. Khemani. I hope it was informative for you as well. Thanks for watching and stay tuned.